Hi everyone, thank you for joining us today. In the presentation, we are going to explore how it's shaping consumer behavior from traditional streaming platforms like Netflix to short-term video apps like YouTube. It's financially impact media companies. As advertising revenue declines, some firms have turned to a controversial accounting practice known as big bets, where they record large one-time write-down to absorb bad news all at once. We will examine how the strategy works, its potential benefit, and what it means for companies navigating ongoing industry disruption. Now, let's begin to understand what is big bets. It's an accounting strategy where a company takes large one-time losses or assessed impairment during a period of poor performance, often to make future earnings appear stronger. It is typically used to absorb bad news all at once, clean the slate, and reset investor expectations. This practice is often criticized as a form of earning management that can distort a company's true financial position. This often happens when there is a leadership change or external crisis, giving manager a convenient excuse to write down underperforming assets, restructure operations, or absorb other losses. While it may seem like a reasonable response to short-term difficulties, critics argue that big bets can be used to manipulate earning and hidden long-term problems. By doing so, they may mislead investors about the company's true financial health.
So in real life, the large-scale write-downs following the merger between Warner Media and Discovery in 2022 are a classic example of big bus accounting. After the merger, the new leadership at Warner Bros. Discovery, led by a newly appointed CEO, quickly canceled several film and TV projects, most notably Batgirl, and removed multiple shows from HBO Max. According to Next TV News, WBD expected to take $2 to $2.5 billion in content-related write-downs in the third quarter of 2022, with total restructuring costs estimated at $4.3 billion. At the same time, Yahoo Entertainment reported expected costs of $800 million to $1.1 billion for severance, retention, and relocation, plus $400 to $700 million for facility and contract-related charges. This aligns with the definition of big bus accounting, when a company uses leadership changes to recognize major losses all at once, clearing the balance sheet for fresh start. This practice offers several benefits. It makes future profits appear cleaner and more stable. Investors may view these losses as one-time charges, avoiding panic, and new management can shift the blame to the previous leadership while positioning the company for resets. This is a real and strategic use of big boss accounting during corporate transition.
So granting managers the flexibility to charge impairments on assets provides several important benefits. First, it enables the management to apply internal knowledge and forward-looking judgment which standardized depreciation cannot capture. For example, managers can quickly adjust the carrying amount of assets to reflect the actual operating conditions better when facing sudden market changes. And during the 2008 global financial crisis, Hire proactively impaired overseas assets based on internal assessments of future demand. Management used forward-looking judgment to reflect actual operating conditions instead of relying on standard depreciation, helping the company adapt quickly to global market changes. Secondly, this discretion helps enhance the relevance and timeliness of financial information, especially when goodwill is overestimated from past acquisitions. By conducting impairment timely, it can prevent financial statements from being misleading. For example, like Microsoft recognized significant goodwill after acquiring Nokia in 2013, and by 2015, the performance failing prompted Microsoft to record a 7.6 billion impairment, which avoided overstated asset and ensured financial statements remained relevant. Moreover, granting management discretion also supports strategic earnings management in appropriate situations. For example, conducting a one-off asset impairment during a year which already has a poor performance can reset market expectations and enhance comparability of future financial performance. The case presented previously has represented this advantage. As Warner Bros. Discovery has already posted losses that year, this feedback reset investors' expectations and improved comparability in future financial performance.
Okay, to analyze the accounting impact of this acquisition of WBD, I will explain it from two perspectives, ASB 10 and ASB 3. As you can see, this table is sourced from WBD's 2024 annual report, where we can obtain key figures such as total assets, ordinary, non-controlling interest. And so firstly, after buying WBD, Apple must prepare a consolidated statement under ASB 10. It made all intra-group balance and transactions, so only external activities remains. Show NCI separately in equity to reflect third-party takings. In WBD's 2024 annual report, ordinary NCI is US dollar 1792 millions, and the redeemable NCI is US dollar 109 millions. Yes, and secondly, under ASB 3, Apple does a purchase price PPA at the acquisition date, identify net assets at fair value and the goodwill, as you can see. So any exceeds of purchase price over the big amount is recognized as goodwill on Apple's book. And this slide shows our calculation process and the journal entries. The accounting impact of Apple's acquisitions of WBDs is illustrated here.
Now moving forward to our post-acquisition of Warner Bros. Discovery, WBD by Apple Incorporated. Firstly, we recognize why do assets need to be tested for impairment. According to ACCT, some non-financial assets need to be tested for impairment either annually or when indicatively. So why? They provide useful and meaningful information for investors and other users of financial reports to make confident and informed investing decisions. Also, this truly reflects the company's financial position and performance. Secondly, impairment testing is the process of reviewing the asset's value on book of the company or its carrying amount to determine whether they're still supportable or should be reduced. The simple formula here is impairment exists when the carrying amount is larger than the recoverable amount, and the impairment loss is a shortfall of these two. So you can see that the figure shows how WBD's intangible assets is decreasing, notably goodwill, taken with 2024 annual report. So, given the acquisition of WBD by Apple in 2025, plus the assumption that the following years will see a continuous declining in viewership, the following assets value could be reassessed and recorded impairment. So first, we got goodwill. A decrease in the future viewership is an indicator of a shrink in the future economic benefits mentioned in the goodwill definition. Therefore, it is likely that the following annual impairment tests of goodwill are likely to record an impairment loss on this asset. Secondly, we have contents, rights, games, trademarks, trade names, subscriber relationships, and PPEs. And these are categorized as non-current and non-financial assets, which are covered in AASB 136 or AIS 36. These are tested for impairment if circumstances indicate that carrying amount is not fully recoverable. And our scenario here is the decline in the viewership that leads to the decrease in projected revenue, customer churn, and underutilization of these assets. Lastly, we move to the accounting implications. So to record impairment losses, it writes off the assets and record the loss by impairment loss to the corresponding amount. So we debit loss on impairment and we credit the assets item. Also, impairment loss is not tax deductible in most circumstances, according to ASB 136 or AF 36. However, for some assets, a decline in carrying amount will give rise to a deferred tax asset or a decrease in deferred tax liability, depending on the taxable or deductible temporal difference, according to Grant Thornton 2022.
That concludes our presentation today. To recap, I introduced the basic